We are back and joined in studio by David Gitau. David is a senior analyst at Cited Investment. We have been talking about debt, public debt situation in Kenya. We went through a debt that was published earlier in the year by the company Cited, and now we are coming to the tail end of this conversation. Before we took a break, we're talking about the current account deficit. This typically tends to have an impact on currency. We want to hear David's thoughts on this, as well as inflation risk or interest rate risk if you are a portfolio holder, and then we will be able to finish the show. As always, we invite you to send us your messages. Do you want to know anything about public debt? Do you have any concerns? Our number is 20146, and that's on your screen as you can see it. You can also reach out to us on social media. That's either Mbithe Mwema or Metropole TV. David, before we took the break, you're talking about the current account deficit. Is there any read-through for the currency? You're saying this current account deficit is going to become weaker, it's going to deteriorate. How then should we look at the currency, which you're saying is already down 6.9 percentage points?
So for the currency, from where we are sitting, we're looking at probably the best case scenario. It will be trading at almost the same levels that it's at right now, because we don't see any fundamental shifts by the end, probably in the short term. Because if it's the foreign exchange earners, we don't expect any very major changes. Even if probably the travel restrictions continue to be lifted, we don't expect probably an influx of tourists by the end, probably in the short term right now.
Okay.
On the other side, I think the only thing that is supporting the shilling so far has been diaspora remittances, as well as receipt from the things such as horticulture.
Okay.
So at best, the best case scenario, expect the Kenyan shilling to probably trade at similar levels until the end of the year.
Okay, fantastic. And then when we look at interest rate risk, inflation risk, when you're looking at a bond portfolio, do this concern you? Are you concerned about inflation for one?
So for inflation, I think so far what we've seen, initially when COVID was starting, there was those expectations of probably inflation would hike, but we saw that was mitigated by the decline in oil prices during that same period. In as much as probably oil prices have since then readjusted, we've also seen this year we've had relatively improved weather conditions. So inflation has been has been stable so far, averaging around 4.5 thereof.
Okay.
The only risk pertaining to inflation so far is, especially for fixed income investors, the problem that we've been seeing is interest rates in terms of probably the T-bills have been declining so far. Let's say a paper like a 91-day T-bill is trading at around 6.2 thereof, and inflation is at around 4, or maybe at around 4 to 5.
Yes.
So this is having an impact in terms of maybe the real rate of return, because it's declining.
Okay, fantastic. So that's the overview on inflation in terms of it's affecting more the shorter end of the yield curve rather than the longer end of the yield curve. What about, I know we've touched on interest rate risk, but do you think the rates could come lower from where we are, or should we sort of expect them to remain where they are for another year or so?
So far, I think we've already reached the trough, because if we were to look at even the subscription so far with the 6.2% in terms of the 91-day T-bill, etc., we have been seeing a reduced participation in the market.
Okay.
So we don't expect probably the rates to decline further than that.
All
and
right.
From my earlier comment that I'd given, we expect probably in the medium term we can see maybe a slight upward readjustment due to maybe the government trying to plug in that fiscal deficit.
Okay, fantastic. And the final question, I know there's a triple issue. We were discussing this on the break. There's a current issuance by the Central Bank of Kenya with a value date of, I think, 21st of this month. There's a reopening of 2 15-year papers and 1 20-year paper. Maybe you can give us an overview and tell us what paper you are recommending to your clients.
So far, yes, this month we have a triple issue. We have one with an effective tenor of around 5.3.
Yes.
Another, I think, around 10 point something years, and another one at around 12 years thereof. I think on our end, the recommendation is we are having a bias towards the shorter term papers.
Okay.
In terms of, so that maybe investors can try and avoid that duration risk. But with the triple issues from the CBK governor last time, we had him mentioning that Probably they are issuing these papers so that they can be all inclusive, so that they can cater for all investors, for the ones with the longer term,
Yes.
medium term, or short term. So you'll find based on your investment profile, but for most local investors, we're advising the shorter term.
The shorter term. So that's the 5.3 year.
Yes.
All right. Is there anything else that you'd want to bring out on the public debt that perhaps I failed to ask?
I don't think
Or a
so.
parting shot?
I don't think so.
Okay, fantastic. Thank you so much for your time, David. That was David Gitau, who is a senior analyst at Citon, taking us through the public debt scenario in Kenya. Debt is still a key concern. He says that COVID could possibly make the debt to GDP ratio worse. But what he also says is that the interest rates might not necessarily get lower than where we are. David also tells us that there's more interest and there's probably better opportunity for you as a fixed income investor to put your paper in the longer dated papers. There has been a bit of weakness when we look at the 91-day and the 182-day T-bills. They're trading closer to the 6% mark, but there's probably more opportunity for you. David also tells us that there is a triple issue by the Central Bank of Kenya. 2 15-year reopens as well as a 1 20-year reopens. The tenor, in other words, the maturity of these papers, one of them is 5.3 years, another one 10 years, and another one 12 years. There is an interesting coupon on this, at least for the 5.3 year, that's a 9% return per annum in terms of the interest you could get each and every single year if you do not decide to trade it. So it looks like there is an opportunity in the fixed income market. Liquidity still is trickling into this space. Perhaps you can be part and parcel of this opportunity. Do let us know if you'd like to know more, and that's all we have for you this afternoon. Good day.